In this video, we will be exploring the key considerations you need to make when deciding whether to sell your company stock options. We'll delve into understanding the buyback offer, evaluating various factors, and seeking advice for a more informed decision. Let's start by outlining what we'll cover in this video. First, we'll help you understand the offer your company has made to buy back stock options. Next, we'll evaluate the key factors you should consider. Following that, we'll provide some advice and suggestions, discuss common scenarios, and finally wrap up with some closing thoughts. Understanding the offer is the first crucial step. Companies often buy back options to simplify transactions. This can be triggered by changes such as investor departures. It's important to recognize that the offer price is typically based on the current, often higher, valuation of the company. However, be aware that the company seeks to benefit itself, although that doesn't necessarily mean the offer is unfavorable. When deciding whether to sell, several key factors should guide your decision. Evaluate the current value of your options against their market value. Assess the company's future potential and your own financial needs. Consider if the offered sum is significant to you. Diversification is another consideration. Too much stock in one company increases risk. Also, note any investment group departures, which might indicate potential future changes like a sale or restructuring. Let's test your knowledge. What should you consider regarding the future potential of your company when deciding whether to sell your stock options? Here are your options: the likelihood of an acquisition or IPO, daily stock price changes, competitor actions, or weather predictions. You may pause the video now to think about the answer, and we will discuss the answer in the next section of the video. Did you guess the likelihood of an acquisition or IPO? That's right. These events can significantly increase the company's value, and understanding their probability is crucial for making an informed decision. Now let's talk about some advice to help guide your decision. First, always request complete information about the company's recent valuations and future plans. This will give you a clearer picture. Compare the offer to your share's market value to ensure it's fair. They might try to lowball you. Timing is everything. Determine if you need funds now or can wait for a potentially bigger return. Lastly, don't hesitate to seek out a financial advisor if needed. Understanding common scenarios can further enhance your decision-making process. If the company is preparing for an acquisition, simplifying options makes it easier. They might also be planning a significant funding round or product launch, potentially increasing valuation. Analyze the company's leadership and strategies. Stable management often provides stability and growth potential. Let's try another question. Why might a company offer to buy back stock options before an acquisition? Here are your choices: to simplify the sale process, to decrease company liabilities, to alter stock prices, or to invest in new employees. You can pause the video to think, and we will go over the answer next. The correct answer is to simplify the sale process. Companies buy back stock options in anticipation of an acquisition to make the transaction less complex. Finally, let's wrap up with some key points to remember. For smaller grants, the risk of holding might outweigh any reward. Sometimes cashing out is a safer bet, removing uncertainties. Follow up with the company for detailed information about their valuation and strategy before making your decision. Thanks for watching. Make sure you like this video if you found it helpful, subscribe to keep learning more about finance and strategy, and leave your thoughts in the comments below. We want to hear from you.